Welcome back, ladies and gentlemen. My name is Josh Castillo. If you like value investing, you like talking about companies, you like learning about different value investors, super investors, what they're doing, how they do it, why they do it, make sure to subscribe down below. I'm just a normal person trying to give my perspective on things. So if that's something you're interested in, make sure you stay tuned, hit the subscribe button, like the video, all that good stuff. So let's dive right into Meta platforms and what happened with the earnings. Now, one quick note, I'm going to be sharing my screen, showing you what I'm seeing. I have a presentation and all that stuff for you. So let me know if you think about the format, as well as if you have any audio issues for my mic. Let me know what you think as well. I want to make one quick note, one quick disclaimer. I do own shares in Meta. I actually went from 20 shares to 12 shares, so I sold 8 shares not that long ago, probably within the last week or so, because I had a lot of exposure to Meta. I think it was like almost 20% of my entire portfolio, so I cut that in half almost. And I wanted to lower that a little bit because I don't like the fact that how much it was making me sleep a little bit less easy at night, knowing how much of my portfolio was dependent on Meta. So with that being said, let's take a look at the earnings. So obviously you can see here on the screen, this thing was, bouncing between, what is this, 221 to about 206s with the lowest on the screen currently. But honestly, back in October, it was at a low of $80 to $90. I think 52-week low is about 80, top 80s. So I honestly can't believe that it's at 237 today. It's been one of the best performers in the S&P 500, obviously, given what happened. But it seems like the turnaround is liked by Wall Street, and obviously the most recent earnings, and that's what we're going to be talking about today, has pushed it up quite a bit from 209 to about 237 is where it's at currently. But this is during the trading hours now, so it's going to keep going up and down throughout the day. Now, looking at the earnings and kind of what came up and what happened, I really wanted to point out kind of where we are at with everything. So as far as the PE goes, based on the current price and the most recent last 12 months earnings, the PE is actually around 25. I know this shows 21, but it's realistically on ticker, the new PE stuff isn't in yet. The earnings isn't in yet for the new quarter, but it's around 25. So you can see, like, over the last couple of years, it's been trading right around 22, 23. So from a PE basis, it's probably a little bit overvalued, but we'll have to see, because again, there was a quarter in there where they basically wrote down a ton, and they're continuing to restructure and give costs. So part of those reduction in earnings comes from those restructure costs that are probably one-time costs throughout the year. Now, what the real difference is that I'm going to be looking at is this sort of, I put everything in slides. I figured this would be an easier way for me to show you and kind of stay structured rather than kind of going through everything and all the PDFs and everything like that. So I'm just going to highlight the summary of important things, but there's probably other stuff that you should go look into. If you haven't already, make sure to look at the earnings and go through it yourself. But the first things first, obviously the financials. We're going to look at this financial statements. So as far as the balance sheet goes, nothing crazy really happened. A slight reduction in cash and cash equivalents, as well as liabilities and assets for the most part stayed the same. I mean, going from 185 billion to 184 billion is basically it's not a lot. Same thing with the liability side. And then obviously the total stock equity will end up going down if they continue to repurchase shares at an accelerated rate. So, and that's what's happening too. Now, as far as the the performance of the quarter versus last year, it's $28.65 billion. It's an increase of 3% year over year. It would have been 6% on a constant currency basis. So if the currency, the US dollar, would have stayed the same as far as the exchange rate goes, 6% is what it would have been. The total costs and expenses, $21.42 billion, an increase of 10% year over year. Again, a lot of the costs and things that we're going to be seeing include restructuring costs in them. So there's a lot of one-time costs that are being flowed through into this now. And, granted, it's not like a ginormous number, but over the 2022 and 2023 numbers, you'll see it. So it's something that you should adjust for, or at least just look into, because it is a cost to the business, obviously, but it's not going to continue happening over the next couple of years. Again, $1.14 billion is what the restructuring costs are for the first quarter of 2023. And then CapEx, including principal payments on finance, were about $7.09 billion for the first quarter of 2023. Now, restructuring costs and impacts, again, as I mentioned earlier, it's going to impact your cash flow. But as far as what they came out to, net cash provided by operating activities, $13.998 billion, just slightly down from last year. Again, not that surprising at all. They are upping their property and equipment purchases, and as well as they're trying to like decrease their financial lease obligations by, downsizing some of their structures and things like that in office space. Again, they are going to continue to rebuy shares and repurchase shares on the market. So 9.365 billion is what they spent over the last quarter. And, again, nothing crazy coming out of this quarter. It's actually kind of mute for the most part, besides the restructuring costs and, some of the color that the executives gave over the quarter. Now, looking at the restructuring costs, so they said we incurred additional pre-tax restructuring charges of $621 million in the first quarter of 2023. In March 2023, we announced 3 rounds of planned layoffs to further reduce our company size by approximately 10,000 employees. In connection with these layoffs, we expect to incur pre-tax severance and related personnel costs of approximately $1 billion, of which $523 million was recognized during the first quarter of 2023. The remaining charges will be substantially recorded by the end of 2023. So they said total restructuring charges recorded under our FOA segment was $934 million and Reality Labs segment was $210 million during the first quarter of 2023. Excluding these charges, our operating margin would have been 4 percentage points higher and our diluted EPS would have been 44 cents higher. So again, they kind of break out the charges and what would have actually happened on the EPS side. So, when you're looking at this, you have to take into consideration what they're doing as far as, if they're restructuring and they're getting rid of people or getting rid of facilities or anything like that. You have to take that in consideration that it's not like a charge that's going to keep happening year over year, especially because like a lot of those salaries are very expensive and they're not going to have them next year versus what they have this year. Now, earnings presentation, I wanted to take a look at the segment results really quickly, and this comes from the earnings presentations that they had, and I pulled out a couple of slides. But really from this, what's important is if you look at the quarterly number, so up here where it says advertising, that's $28.1 billion for the quarter. And if you look at last year, 26.998, not really that surprising when you think about what happened last year as far as Ukraine, Russia, and all the stuff that happened that reduced their sales. It was more so impacting at the end of Q1 into Q2, but it still impacted Q1's numbers. And then obviously the Reality Labs is pretty much down almost half from where it was the last quarter and pretty much last quarter sequentially and year over year. So that's something that I think people should watch out for as well, because again, if you look at the bottom, they're still spending a lot of money on Reality Labs. Granted, a lot of this is seen as like this is building up the growth and the foundations and everything in the business, but it's still something you want to pay attention to, because you look at the FOA side and the operating income from last year, it's about relatively the same, again excluding the restructuring costs. But if you look at the loss, it's a lot higher than it was last year. So they're going to continue this, but it's something that I still think people should worry about and watch. Again, the operating margin there at the bottom. Advertising revenue by user geography. So this is, incrementally higher on most of these. So you take a look, the only thing that didn't come back was Europe. Again, not really that surprising given what's happened. And then obviously, incremental on the rest of that. But Asia Pacific seems to be where a lot of the advertising revenue, and they kind of talked about it in the earnings call, a lot of advertisers from China and other places in Asia Pacific are coming back and actually marketing e-commerce. Family daily active people. Now this is across all the FOA apps. So it's going to be Instagram, Facebook, Messenger, and WhatsApp, all the, everything. They're about 3.02 billion, which is great. I mean, look at the growth just over the last two or 3 years. It's kind of insane when you put it like all together. Like if you go through like all the earnings presentations from before and look at it, it's crazy to me. Like 3 billion users or people are active. That's pretty much a third of the world is on one of these apps. So you look at the monthly active people as well, 3.8 billion. Again, it's crazy to me monthly that they have this many people accessing their apps. And again, if you look at the bottom here, I left the notes. So if you want to look at it, it says, as a registered and logged in user, one or more family products who visit at least one of these products through a mobile device or application or use web in the last 30 days. So it's really for both of them. I left the note at the bottom. It's really just people who've logged on and registered. So, whether or not they're on there forever, Meta has that information, but they obviously don't share it. Free cash flow reconciliation, you can see the free cash is slowly but surely going back up. Again, they're spending a lot of money on CapEx this year. I think it was like 30 to 35 billion is what they're looking at. And if you look at like the last 12 months, so Q1 through Q2, the big overhang is this $173 million in free cash flow that they had. And not really that surprising given, again, what they're spending on CapEx, but it's something that I think people need to pay attention to is what's the normalized rate of free cash flow. You can see the years before they had some great free cash flow, and if you go back even further, they had some great free cash flow because, again, it was just advertising. Now that they're spending on Reality Labs, free cash flow is going to be down quite a bit because of the fact that they're spending so much in Reality Labs isn't returning anything yet. So it's something though, like what is the normalized rate of free cash flow? What is the normalized margin of free cash flow, and those kinds of things? What I'm paying attention to. Now, as far as the earning calls go, there wasn't really too much that I wanted to get into. I kind of want to just go over quickly like what they said on the earnings call. So this actually came from I believe it was the actual earnings piece, and then I have some stuff from the earnings call itself. So they said our investment in recommendations and ranking system has driven a lot of the results that we're seeing today across our discovery engine, reels, and ads, along with the surfacing content from friends and family. Now more than 20% of our content in your Facebook and Instagram feeds are recommended by AI from people, groups, or accounts that you don't follow. Across all of Instagram, that's about 40% of the content that you see. Since we launched Reels, AI recommendations have driven a more than 24% increase in time spent on Instagram. Our AI work is also improving monetization. Reels monetization efficiency is up over 30% on Instagram and 40% on Facebook quarter over quarter. Daily revenue from Advantage Plus shopping campaigns is up 7 times in the last 6 months. Our work to build out business messaging as the next pillar of our business is making progress too. I shared last quarter that click-to-message ads reached a $10 billion run rate, and since then, the number of businesses that using our business messaging service has grown by 40% quarter over quarter. Our success here depends on delivering results from other businesses at our scale that can have macroeconomic effects. We recently did a study with economists at UC Berkeley to understand the impact of our services make, and they concluded that every dollar spent on our ads drives on average $3.3 in revenue from our advertisers in the US. So that means over $400 billion in economic activity annually is linked to supply chains relying on our platform, supporting more than 3 million jobs. So this is something that I think, though, is really important because it gets to the point of what this business does. Again, I know they have Reality Labs, but the big piece of their business, that FOA piece, it's all about connecting businesses to people to people. Like that's the overarching piece of it. And I know that advertising is like a big component of it, but they seem to do a really good job of connecting people and connecting businesses and customers and things like that. It's really like the physical products is, I think, where they're lacking on their business. So it'll be interesting to see like over the next year, 2 years, what the Reality Labs side looks like, but it looks like the FOA side is well taken care of, continuing to grow. And I think that the AI improvements, and I know that AI is like a huge buzzword right now, but they have been talking about AI for like the last like 3 or 4 years before AI even became like a huge buzzword that people were using. And really, again, they're building their own AI for their own in-house stuff. This isn't like they're going to sell this AI or anything like that, but they're going to build one of the biggest supercomputers in the world, and they're going to use that for their recommendations. And this is to get over that Apple privacy changes that happened. And it seems like the lapse that we're having, like, 2023 versus 2022 versus 2021, the pre-ATT privacy changes, what happened was, we're going to have these lapses. So we're going to see realistically what the numbers look like, free cash flow, earnings, all that good stuff. So one question that I didn't grab too many questions. I just grabbed this one from the earnings call. I did look at all of them, but if you want to go back, they have the earnings call transcript on their website as well as the rest of everything else that comes with earnings each quarter. So Colin Sebastian said, "Oh, great. Thank you, Deborah. Good luck with the next move." And da-da-da-da. So Colin Sebastian said, 2 questions on the expense side. I guess first off on Reality Labs, just contemplating the kind of operating losses in the long-term vision, was just hoping for maybe some detail on how productivity efforts or restructuring efforts help reduce the intensity of annual investment required in that particular group. And then secondly, I know this may be hard to answer, but trying to splice out the cost of AI initiatives and particularly generative AI, since you've had AI for years, but this is incremental AI. Is there any way to quantify the cost of that, whether that's from infrastructure or OpEx perspective? Susan Lee said, okay, so the first question in Reality Labs, sort of the contemplating operating loss. So we've talked about, I'm just going to skip ahead. So we've talked about our efficiency efforts as having two broad components. The first, kind of going through and reevaluating roadmaps, reprioritizing projects, and effectively, I would think of that as areas where we are shrinking scope. And the second is sort of the second effort in efficiency workstream has really been around making the organization more efficient, and that has been work like spans and layers, making sure that we feel like we have sort of the appropriate cross-functional staffing, that we're looking to streamline processes. That's not really about scope reduction. That is about just making the organization more efficient and productive. So when you look at these two efforts, what I would say is the scope of our Reality Labs ambitions, especially over the long term, has not changed. In the short term, there are places where we have made product changes. I think sunsetting Portal, the consumer portal line last year, was a good example of that. But the magnitude of the long run vision, opportunity, and ambition for the Reality Lab remains the same. So you'll see that certainly play through in the forward-looking investment in Reality Labs. So Reality Labs did go through the same sort of organizational efficiency exercise as well as all of the other teams across a family of apps. So they're certainly becoming more efficient in that processes as well. But I do not think it's important. I do think it's important to emphasize here, we think that the long run ambition of our Reality Lab work is still great. We think we're still building a sort of a future of computing platforms, and we're early in the process of putting together our long-range plan, which helps us benchmark what some of the product roadmap can look like. But we said that we expect Reality Labs operating losses to increase in 2023, and I'd expect that to be the case in 2024. So it's a big opportunity. It's very ambitious. It's becoming more efficient, and the long-run scope of our ambitions, I think, has not changed. The second part of your question is across the cost of AI initiatives, particularly Gen AI. So this is a really hard place to try and attribute cost. There is much AI and machine learning work that underpins already so much of our core family of apps experience and product offerings. What I would say in terms of Gen AI specifically is that a relatively smaller headcount team right now because it's a nascent effort, so that's not very significant in terms of percentage of headcount at the company. But it is a place where we're trying to deploy GPU capacity more quickly, and that is captured in the CapEx guide right now, but I do think it's worth sort of double-clicking on Gen AI capital intensity. We're planning to stand up several large-scale training clusters in our data centers. It is too early to tell exactly how much additional capacity we may need to build in the future years to support these use cases, but it's likely that Gen AI workloads will be relatively more CapEx intensive than other AI workloads, given the large-scale compute infrastructure that you need to train Gen AI models, and then what we think will be the relatively high cost of inference for Gen AI applications once we start deploying those across various products and services. So we're all set up operationally to support the work here because of the investments we made in our infrastructure strategy and future data centers we're building, which should all set up to support our AI workloads. But it's a place where, although 2023 CapEx is captured in our guidance, I would say it's a little too early to know what the impact will be on 2024. So again, it kind of all points back to, and Susan Lee did a great job of kind of explaining what they're looking for. And again, if you look at kind of the last couple of quarters worth of earnings calls, they've kind of, been pointing this out, that they're using AI to kind of combat the ATT changes and what came from the privacy changes, but it's obviously going to be still a little too early to, really give an impact and tell you about what the cost is going to be and all that stuff. But they know, but they're just not telling the street what they do and don't know. But they're building out a huge supercomputer, so we'll see. It'll be interesting to see like how they're able to attribute different things, and really that language learning model is going to be open source. It's something that they're working on because their goal is that they want to make an open source product that they can let other people improve upon, and then they can use those improvements in their current model as well. So it'll be interesting to see that kind of model versus another big tech company and what they're using, because a lot of the other big tech companies are closed models that they're not talking about. No one's going to get to know what goes into them or anything like that. So I'm excited to see that. And then lastly, I wanted to get into the valuation. So I updated all my numbers: outstanding shares, revenue, earnings, free cash flow, all that good stuff. I updated my numbers, and what I found was the net income margin was 18.27%, which is way below, they've been averaging 25 to 30% over the last few years before 2022 pretty much. And then the last couple of, this year and last year had much lower. Now, part of the net income margin story is actually going to be happening because of the fact that again, they're restructuring. There's a lot of costs that flow through that. The other piece is going to be that they're investing a lot of CapEx, and they're going to end up with a lot of assets that depreciate. So that'll be interesting as well. But as far as this quarter goes, the net income margin was, I think, around like 19-20%. But the last 12 months has been about 18%. So looking at everything that I put in here, you can see on the right side my low, mid, high case. Honestly, the high case is probably a little low for what it could be. The low case is probably a little high for what it could be. Revenue growth wise, I think because of CapEx, because of the currency exchange, it could be closer to 0%, 1% on the low end. As far as the margins go, the mid to high margins for free cash flow and for profit margin, that's like what it could be. I think, again, the restructuring costs are real costs and something that they'll have to pay. So in 2023, the margins are probably going to remain under 20% on both pieces. But I think going into the future, as things kind of flesh out a little bit more, I think they'll be able to push their margins back up. And that'll be part of the catalyst story over the next couple of years as far as, where they go. But I think if they're able to get it, I think that the fair value may not actually be 156. It may be much higher, much closer to 200, 230. So it'll be interesting to see. Again, I'm calculating fair value using the free cash flow. So if free cash flow keeps dipping because they're spending a lot and they're doing a lot of different things with the free cash flow and operating cash, that may impact it as well. But as far as where I think this number is, the worst case scenario I think is back below $100. Best case scenario, a little bit above $230, $240. Again, the share price is like right around 238 right now. So it's probably closer, in my opinion, to the high case than it is to the low case or the mid case, really. But it'll be interesting to see, like, margin wise as well as multiple wise, what this company comes out to. Because again, the low end 20% margin, profit margin, 18% free cash flow margin, and terminal PE and terminal price of free cash flow at 14. That's really low. I think the revenue growth is probably still a little bit higher, but the high end, that's kind of what they were performing before. So if the market thinks they're going to go back to 30% margins as well as 20 to 25 multiple, it's about where it's at today. So it's interesting to see what may or may not be priced in. I think the high case is probably priced in at this point. And again, going back to what I had said at the very beginning, this whole story about it running back up from $80 to $240 is why I sold. Now, I didn't sell at $240, obviously, because this just happened today as I'm recording this video, but I sold at about $220, $222, I think is where the number, $219 was about the number that I sold at. So I sold 8 shares. I didn't sell because I don't believe in the company. I sold because I didn't want to be overexposed to the company. So I'm going to take that cash, find new opportunities where I can, and I'm not really worried about that. Now, in conclusion, though, thank you all for joining me today. I like Meta. I love the story. I love where it's going. I do think it's probably towards the higher end now, probably a little bit more expensive, and I don't plan on adding today, obviously, since I sold 8 shares. So let me know what you guys think down in the comments below as far as what you thought of the earnings. If you've read through it yet, let me know what you think of Mark Zuckerberg and Susan Lee's answers on the earnings calls. I think the earnings call actually gave a lot more, insight into what they're doing as far as progression and AI. It seems like AI is the buzzword of everything right now. So if you want to get an idea of what they're doing with their technology, I think you should look at the earnings call. It gives a lot of, both the earnings call and the follow-up that they did. But with that being said, thank you all for joining me today. I hope you have a great day and happy investing.